Hello, this is Judith Paquette, and we are starting the new section, Fraud, Internal Control, and Cash. So this whole chapter is about internal control, cash management, cash and accounting for cash, and then a really important piece, which is the bank reconciliation. And the last part of the chapter is correcting journal entries. What is fraud? Oh dear. Fraud is a dishonest act by an employee that results in personal benefit to the employee at a cost to the employer. So the key phrases here are: it costs the company money and it's personally benefiting an employee. Okay. And it has to also be a dishonest act. So a couple examples, basic ones: employee stealing from the cash register, employee taking office supplies home for personal use, employee putting extra time that he did not work on his time card, or an employee creating false financial statements to create an increase in the company's stock value and then selling all her own stock at the higher value before anyone finds out and the stock value drops. All of these benefited the employee and cost the company money. Why does fraud happen? What we look at here is the fraud triangle. There are three things that come together here: financial pressure, rationalization by the person stealing, financial pressure on the person stealing, and the opportunity that the company somehow lets happen. So let's talk about those three. So financial pressure. When people owe money and have debts and they're coming due and they don't have money to pay their debts, that's pretty scary. And that provides a low stress level that grows and grows until it is a high stress level. Sometimes it's based on real debts, and sometimes it's based on feeling like you just don't make enough money. All my friends are going to have a wonderful weekend in Las Vegas. I really want to go. It's not fair that I don't make as much as they do. Or my car payments are too high. Or, as in my experience, we had fraud at a place that I was affiliated with, and the woman said, my husband had surgery and we needed the money to pay the medical bills. All of those situations create pressure for the employee. Rationalization. Rationalizing is a tricky thing because it's in our head and it's a way of saying this is okay. I earn a low wage. I got passed over for promotion. This company makes so much money, they don't need the money. And this one I've seen many, many times. I am only borrowing the money. I will pay it back. You're not borrowing the money. You took the money. You stole the money. Or everyone's doing it, even the supervisor. Again, don't rationalize something that feels wrong. Finally, and this one is on the company, and this is opportunity. The company must try to reduce and eliminate opportunities for fraud. That is their job. And this is going to require a lot of elements of internal control that we're going to talk about on the next slides. But it's really important that companies have tight internal controls that don't stifle the company, but provide the right amount of protection against fraud. Okay, we're going to move on to internal controls. So around the year 1998, 99, 2000, there were some very big frauds with publicly held companies in the United States. These happened, and Congress responded. The United States Congress responded by passing the Sarbanes-Oxley Act of 2002. This act created another layer of audit and oversight for publicly held companies. It created additional requirements that had to be met in order to receive a good audit. Now, there's a lot of arguments about the Sarbanes-Oxley Act, But you have to remember, at that time, and even occasionally in these times, certain bad actors in companies were stealing millions and even billions of dollars. And so paying extra for additional audit was a way to protect the company and the shareholders. If you're interested, you can look up some of the 10 worst accounting scandals and see how bad it really was. So the goal of internal control is to safeguard a company's assets. So remember, company's assets are things like cash, accounts receivable, inventory, equipment, trademarks, patents. The goal is also to assure that financial statements are reliable. Is the income statement correct? Are sales correct? Is net income correct? Is the balance sheet correct? Is the cash flow correct? And remember, we'll be going over cash flow in Accounting 202 in much greater detail. Another fun aspect of internal control is efficiency. So looking at a company from the point of view of, is this company being run well? Is there a better, faster way to do these things? That is also a goal of internal control. And that can be a real fun career for those of you that like to consider a career in consulting, where you go from company to company and help them become more efficient. And of course, compliance with government laws and regulations. So how does a company do this? How does a company do this? There's 5 things that a company has to have. They have to create a control environment. And this really comes down to this phrase, tone at the top. Tone at the top is important. Either they are committed to internal control and they act like it and they provide the resources for it, or they don't. If you don't have the right tone at the top, and that means the top management have to buy in to internal control. Now I have to tell you, I worked in audit for many years, and often the auditors are seen as people that keep the company from doing its business, when in fact they're more like partners keeping the company on track. But that tone at the top comes from the chief executive officer, the president, and vice presidents of the company. Companies also required to do risk assessment, and that is a way of looking around the company and saying, where are the weak points? Where are we at risk of fraud? So let's take an example. If an entire department, accounting department, was new people who didn't know the company, didn't know how the company does things, there would be a greater risk for errors and possibly fraud. And yes, I have seen that in my career as well. Control activities, a company has to have a good set of policies and procedures and make sure that they are followed. Of course, information and communication, so that people know what is the right thing to do, and that when there are audits done, when internal control is reviewed, that result is reported back to management. And constant monitoring. It isn't good enough to say, yeah, we looked into that 5 years ago. You've really got to be more consistent. All right, types of internal control. Prevention is the best. That means you stop a problem before it happens because you've already created the systems in place to prevent it. But of course, detection is the other type, and that means when a problem's happen, when a fraud occurs, you're able to find it out, discover it as soon as possible after it happens. So if you have systems in place, if you have, with the aid of computers, where you can identify suspicious patterns in data, that's a way to say, hey, this looks like something might have happened, and to go and look into it. This concludes our first discussion on internal control and fraud.